Today we're here with James Ouderkirk of GLASfunds. James, thanks so much for joining us today, man.
Of course, great to be here.
Awesome.
Why don't you give us a quick on your background?
Sure. Yeah, absolutely. So again, kind of as reference that, I grew up, a number of different places kind of over the arc of my childhood, but really kind of fell into, kind of my professional career, school at Notre Dame, following work into public accounting in the Chicagoland market. Ultimately transitioned into becoming a financial advisor to ultra high net worth individuals. Learned, kind of that business and really fell in love with the alternative investment side of that business. My time at BMO Family Office, and at the time had gone through an acquisition of the CTC consulting practice out of the Bay Area. Very high profile clients, lots of very serious allocators kind of in the alternative space. And so to get that sophistication pretty, kind of that visibility into that world set at a relatively early point in my career was great. But, my transition to Ohio, a function of a desire to move closer to family and, come to work with GLASfunds in kind of the 2017 timeframe on.
Yeah. So let's kick it off in terms of tell us what you guys are up to at GLASfunds. What are you guys working on?
Yeah, absolutely. So the business was founded in 2008, and we are at its core an alternatives implementation and execution platform serving financial advisors. So we work with about 150 different financial advisory firms today, serving many thousands of end underlying advisor clients. And again, what we're really delivering is turnkey operational infrastructure for these financial advisors to source, scale, and execute upon private markets and hedge fund absolute return type of opportunities for their clients in a alt UMA or kind of omnibus solution, whereby again, clients are getting a single statement, a single K1, but they've kind of got the freedom of choice to really build their own experiential set in the private market space. So we're north of $4 billion in platform assets today. And, again, kind of the day-to-day of the firm is, serve all of our great in-force clients, continue to grow, continue to add functionality, enhance the solution as it stands today, find new and unique, interesting ideas for our advisors to work on. And I'm kind of involved in all parts of it. We're about 40 team members, the majority of which are in our Cleveland, Ohio headquarters.
Yeah. Before we get into like some of the trends and things you guys are seeing, talk to us about kind of who do you guys work with? Obviously, like high net worth individuals.
Yep.
I assume like RIAs are pretty big.
Yeah, they are. Yeah. So our client set is pretty diverse within that 150 advisory kind of firm, bucket broadly, but overarchingly, it's private banks, independent registered investment advisors, so kind of away from the wirehouses. And that is, I think within that even, a lot of disparity, right? There are difference, there's $200 billion plus national roll-up firms, and then there's, $200 million solo practitioners. Yeah. The platform is really kind of a solution for folks at any point. But the bulk of our clients are kind of that, I'd say, $2 to $10 billion independent RIA private bank that, has scaled into a place where they recognize the need for an alt solution, maybe have been a direct allocator or utilized like a feeder fund platform historically, and kind of coming to a point where they say we need something that's a little bit more holistic in its ability to manage portfolio of alternatives and not just solve for access.
Yeah, that makes sense. You mentioned earlier about kind of like a 1K1. How does that process work on your platform? I'm just curious.
Yeah, so at its core, we draw a lot of comparisons, I think, sometimes to feeder fund type platforms. One of the key kind of structural advantages that we would promote really is this 1K1 solution for taxable clients. So ultimately, the way that works is our operating mechanism is two platform structures, one on and one offshore, for the onshore clientele, because all of the investment ideas that they're participating in are through one master entity. At that entity level, they're only receiving 1K1. And so the iteration, and really kind of at the core of kind of what we do in our own development, is to offer, again, out that freedom of choice and that customization of each client and client holdings, but making it livable for these folks to ultimately invest in a bunch of alts and not have 15, 20 different K1s they're trying to track down at the end of the year from 15 or 20 different places. They know they're getting one kind of from us, and it's by virtue of that platform level aggregation legally, but still retaining that ability to have freedom of choice in the investment decisions, which again, I think we've just seen in the sophistication of advisors and how things have evolved and what clients want and being responsive, that demand to have that flexibility and creation, but not have it create more work on the tax reporting side is a big component of what we do. But at the end of the day, it all functions off of that fact that everything is running through the platform.
Yeah, it definitely makes sense. So it's like a series LLC structure, essentially, or?
That's right. So there's a few different component parts to it, which again I won't bore you with. But at the end of the day, yes, there's a Series LP, Series LLC structure that achieves all of this, and then of course many layers of kind of bookkeeping, kind of at our level and on an independent administered basis as well. That is really, again, kind of what allows for that selection choice, but still the syndication benefits that you would associate like with a fund of fund.
Oh, very cool. Yeah, so each kind of underlying investment, it's like a sleeve. It's more
That's
protected,
right. That's right. So kind of tying into that whole, how do you make this happen? There's the 1K1. I think the other element, as I refer to kind of this being an infrastructure solution, primarily for these advisors, is giving them the capability to open up a new sleeve on the platform for an idea of their own sourcing at $1 million plus of aggregated interest, right? So they aren't fighting this battle of, I need to find 25, 30, $50 million of demand, or consider a multi-manager solution just to bring an idea to my clients to get through kind of the launch costs, the startup timeframes, amortize all of those legal expenses out, make it bearable and supportable, as a fiduciary for my clients. GLASfunds is saying, we can give you the capability to launch those types of solutions. You just need to bring $1 million plus of aggregated interest, which could be 20 clients at $50,000 a piece if need be. So it just becomes much more actionable for these advisors to run on their own ideas, but effectively with each of them, yes, living as a singular sleeve underneath our platform.
Cool. And to kind of get into some of the trends, what are you seeing in terms of advisors that are adapting alternative investments?
Yeah, so I think, as you would know, full well, kind of reading in the press and otherwise, right? Adoption trends and the acceleration of demand is up fairly universally. I talked about our clientele, kind of call it the bell curve of these firms, or these 2 to 10 or 10, even kind of $2 to $20 billion plus advisory firms. These firms 5 years ago were half that size, and some of that is just a function of the way that markets have grown. And so there are a lot more clients now, just by virtue of the wealth effects at really all advisory firms of almost any size, that are fitting a profile and have a liquidity parameter to do more in alternatives. And so I think some of what you read in the press is fair about advisors, that trend of starting with things that are more in the evergreen private credit or private real estate income oriented type of solutions, right? That all holds very true. But actually what we've experienced and kind of been a unique position, I think, because, again, we are open architecture, right? We permit advisors to really bring whatever they want to the platform, is that advisors are still primarily utilizing private markets as a means of return enhancement for their end clients. And so that means allocations over-index to private equity, they over-index to secondaries. Venture, single asset deals have increasingly become popular on the platform. And again, partially because we can facilitate access to these at such a low syndication threshold, but also I think just in the spirit that these are advisors who now have built diversified private equity programs through secondaries, through buyout, through growth equity, and are saying, hey, I'm now pursuing kind of the satellite opportunities or the primary co-investment opportunities that are coming out of the great relationships I have. And we're seeing an acceleration, of that trend across the advisors that we work with, certainly. But again, it's everything is kind of up and to the right. I think the private credit story is certainly there, but really, big allocations still to private equity, and again, a continued demand to branch out and do more of this own source, single asset or single opportunity type deals is coming more to the fore.
Yeah, that makes sense. With kind of talk to us about how you kind of already dove into this a little bit, but to really like break it down, like how have advisors allocated to alternatives historically?
Yeah, historically, there have been kind of a couple of avenues through which to do this. There are those firms that haven't really, kind of done anything, right? And have said, look, we accept for the complexities involved, the bite sizing requirements involved for the client set that we have. It's just not appropriate. And the product evolution there, be it in registered and tender fund type of opportunities, interval funds, and solutions like GLASfunds have certainly made that more accessible, where more of those advisors can have that conversation. By legacy, I think a lot of advisors have really lived in, hey, we're going to take diversified fund to fund, or that one single commitment that we can do at a quarter or $500,000 kind of direct basis for our largest clients. And we're going to call that our private equity or private markets allocation, right? I think that has been, kind of the path that a lot of folks have historically run on. And again, maybe filling that out of the margin with some of these kind of interval fund or other structures that have kind of come to bear. Again, and just having done this for the last kind of 15 years, the acceleration that we see now is just the demands for what lives outside of kind of that core allocation is building. And even within that, I think more advisors are saying, hey, I'm now a $20 billion private bank. I'm going to put $20 million into my next private equity opportunity, and I should be finding a solution on a syndicated basis, a la with GLASfunds, where I can go to that manager and I can say, hey, I want to enhance my economics. Or I'm finding a partner like GLASfunds that says, we're going to do that for you as part of our underwriting and recommendation practices, right? So, again, the evolution, I think, is just more is more. By legacy, it was kind of a one-off, hey, I'll try and do this direct, or maybe I'll, utilize a feeder structure where I can get a $250,000 type minimum. Or an executive share class. Now it's advisors saying, I want to do more, I've got size, and there's a better solution set out there for me to access other parts of the capital markets universe. And frankly, solutions like GLASfunds, which make it far more interesting and accessible for me to do these types of things, like a $10 million co-investment that I otherwise would have had to kind of do a rough pass the hat on with maybe 3 or 4 of my biggest clients, right?
Yeah, that's really interesting. Yeah, I mean, you kind of mentioned this earlier, but being able for your clients to choose their own program and product, if you will, create their own product, quickly on your platform I'm sure it's well received.
Yeah, I think the other trend, and this is almost even really just in the last year or two that we've seen, and I think mapping kind of with our own growth and evolution, is the use of kind of managed programs. So advisors who are saying, we love the pick and choose functionality of what we can get through the platform writ large, but we want to be in a place where we own some discretion. We want to run the 2025 Advisor A vintage program, or just the private markets program writ large. And clients, for some subset of them, they do like that deal by deal capability, and we come to them and talk to them about everything. But then we have this whole other host of clientele who are like, can you just sign me up for the program, right? And the fact that I don't have to break the box to offer both under the same construct with the same provider and still, enjoy all kind of the scale enhancements of what it is that we do, right, has been something that, like, we've done more of those types of programmatic launches with our advisor clients in the last 2 years. It's something we've always done, but I see, just more and more appetite. And again, maybe this is back to the element of you have every advisor now in a position where, they could very reasonably do 25 or $50 million a year in private markets across, a billion, $2 billion type of client book.
Yeah. Very cool.
Yeah, it makes sense. With how many funds do you guys work with?
So there are about 400 unique GPs on the platform today. We underwrite and recommend on an independent basis with our research side something on the order of 25 to 30 a year. So just kind of in the factor of growth. Advisors are probably sourcing on their own, kind of across that universe of 150 firms we work with. There's probably 2 or 3 opportunities that are brought to us to onboard for those clients every week, it feels like. So we're very rapidly getting to a place where, there's 100, kind of plus net new ideas coming to the platform every year. And again, a lot of these then close, right? They're kind of they're open, they close, and then, the positions continue to live on the platform as we manage them for those clients. But some of these are evergreen as well, right? So it's a very, very healthy mix. We still have a number of hedge fund allocators as much as we do private capital allocators. And again, as a reference, kind of that co-investment single deal allocation, growing as well. So it's a wide mix, and it's a large number of funds. I don't know that there's really a marquee GP that at a certain level we haven't had either outright exposure to or certainly not familiarity with. And, all kind of tying back to where we have, relationships, be it groups like Hamilton Lane or Allborn or otherwise as well, right? Lots of leverage points in the universe to kind of meet and know people and find interesting ideas for clients.
Yeah, makes sense.
Yeah.
So you guys are doing your own research and due diligence independent of your client?
We do, yeah. So as you can imagine, within the 150 kind of universe and the folks that we meet every day, there's a wide range of sophistications and kind of business demands for these firms. So we have certain firms who are large, very sophisticated, who have their own independent research offerings inside, and they say, we really love the platform for the infrastructure it delivers. That's all we really need it for. And then we have other firms who say, we really do see research as something that, we would desire, and we offer that on a full kind of take it or leave it basis. It's just part of the platform. We're going to recommend these ideas. You're free to use them or not use them in whatever manner you desire. There's no incremental, kind of economics for GLASfunds and the funds that we recommend, right? Again, back to points of differentiation vis-a-vis some of the other platform groups. It's wholly offered, for advisors to take advantage of should they so desire. So that's a team of 5, again, kind of back up in our Cleveland headquarters. We have outsourced research relationships as well, again, as referenced with Hamilton Lane, Allborn. We work with the GLG Expert Network research. So there's a body of work that goes into, underwriting, recommending, and then monitoring those. But has been an important part of solution growth for us as well, and trying to meet advisors really where they are and in their own kind of life cycle of what they want to do with all.
Very cool.
Mm-hmm. So as an RIA, maybe I come across a fund that I think is interesting. I think I want to get some of my investors invested into it. We could work with you guys to bring these new funds on the platform. Yeah.
That's right. So again, you're an RIA out in the universe and you identify a compelling opportunity in buyouts, and say, this is something that, I could see putting $2 to $3 million in across a couple of my clients, understanding the commitment programs that I've built for them. That's at a size level, you couldn't build a feeder. The GP likely doesn't want to take $50,000 and $100,000 tickets, right? For no cost, you could come to GLASfunds and say, Glass, we'd like to have you open this position for our clients. This is where we expect demand to fall, and we'll be the facilitator. And again, that's also a costless proposition then back to the GP. And if you already have other client positions on the platform, right, then your new buyout idea is living alongside all the rest of them under that same kind of alt UMA, single statement, single K1 type of solution. So yes,
Yeah.
totally open infrastructure in that respect. And again, I have, we as an organization have taken the stance that like we aren't going to have any conflicts whereby, just because I've recommended buyout fund A and you like buyout fund B, right? Like that's great. And if we can be a consultative help and, telling you why we think A, might be better than B or what the rest of the universe might look like, that's all part and parcel of what we're doing with advisors every day.
That makes sense. On that same note, I guess, are you guys due diligencing every single manager like that?
So for the recommended funds that come through the research process, again, there's a qualitative, quantitative review. Hamilton Lane or Allborn is pressed in for operational due diligence on a fully independent basis. We write a 15-page research report, right? That is kind of the leverage function for advisors. For ideas that an advisor would like to bring to the platform, our research team also gets involved and conducts a platform level of ODD, but it will not receive like full investment underwriting. These are cases where an advisor has said, I want to invest in fund A, and we say, great, as long as it's institutional quality and suitable for the platform, we'll support you on that front. But we're not making a research call per se.
Yeah,
makes sense.
Yeah.
And again, just back to the use case of a lot of these are coming from firms who already have a great investment. They have a tenured CIO in the private markets who's done that work. We are just operating as execution implementation platform for them.
Right. Yeah. Just curious, how do the LPs and allocators think about kind of the platform structure? What should they be thinking about as kind of these platforms and what you've created is out there?
Yeah. So I think our experience has been that LPs and allocators have warmed to the notion of the platform solution vis-a-vis kind of the directs and feeders, because ultimately having really alleviating the administrative and operational burdens of doing more in alternatives, which is very much the trend as discussed, is the primary point of pain. The advisors, even the end clients, are saying, I want to do more, but I've sometimes self-limited because it's too painful operationally to access. And so while going direct, may not incur this incremental level of management fee, again, kind of the sole source of economics for GLASfunds being a platform fee at the end client level, getting them out of an incremental K1, another statement, another place they have to wire money, another point of custodial reporting, another place to pipe data into their Adapar, Tamarack, or whatever the case may be, right? They're saying that is so worth it to me so that I can continue to allocate in the way that I want. So the receptivity from the advisor allocators, the LPs, when kind of discussed in that framework, especially anybody who's been down one of those paths, has been high. And we've evolved our construct to address what might have been some of these concerns. Well, I'm in a pool with everybody else. Well, that's no different than if you were in a feeder fund. How do I know that these assets are held in a segregated manner vis-a-vis other things on the platform? Well, Delaware law supports that, and the Series LLC structure supports that on a unified basis, right? So, I think we're always very open on structurally this is how we work. This has been an operating business in that construct since 2008, right? We feel, very, very secure and affirmed in kind of how it is that we bring our solution to market and the protections that it offers those LPs. And again, I think as people just frankly get more familiar, they get more comfortable and they acknowledge the limitations as they're trying to grow practices or frankly just grow their allocations within private markets to continue to do stuff on either a direct or on a feeder fund type basis.
Yeah, to your point, when you're talking about the sleeves, those are all ring fenced, independent of one another from a security perspective.
That's right. That's right. And, again, not without its own, fairly extensive and, look, we've been doing this for 15 years, legal evolutions, of our own, right, to continue to evolve and get to a place of kind of best practices, with industry and, take feedback from advisors and our GPs, right, and continue to iterate. I mean, I think there's a very much kind of a culture, here of saying, we're going to try and, our business number one is making advisors and clients' lives easier and providing them with a great solution that they can feel comfortable with. Like that's what we're getting up and doing every day.
Yeah, that's awesome.
Where do you see the biggest appetite from investors in terms of, new funds and new ideas that are coming to the platform?
Yeah, so we've seen some very, very large allocations to these high profile, kind of later stage opportunities, whether it's, like an XAI or it's some other kind of AI focused opportunity, Databricks, things of these, nature, right? Those can certainly attract a lot of eyeballs, and depending upon how large the advisory firm is that's kind of driving the interest from end clients, those can be, more meaningful allocations, for us on platform. I think, broadly, we see really good interest in those thematic opportunities as well, and especially where like we've negotiated enhanced economics for end clients. So we've done a number of seeding opportunities within private credit, where people, I think, understand the private credit story really well, and they say, well, what's a way in which I can create some kind of structural advantage for me as an investor if I'm willing to help a well-known firm start a new strategy, right? So that's been, a really focused area of interest for us, but kind of back to the intersection of quality and demand that we're looking for from our advisors. This is, what people are looking for. They want to say, hey, how can I know what capital markets are going to give me largely in a lot of these asset classes. What can I do by virtue of Glass's size, our structural relationships with these GPs or otherwise to create incremental levers of alpha for my end clients? I'd say the other area, again, that we see is kind of thematic investing, right? So we did some data center opportunities. We're working on some reinsurance opportunities today that are just a function of, this is what the market is kind of yielding and presenting either demographically or situationally, right? In the case of like the California wildfires, to bring a really compelling opportunity on a best terms basis, executed in a really easy format, right? Like that drives a lot of advisor demand ultimately.
I'm just curious from a just kind of ecosystem perspective. You kind of talked about high level what you're seeing in the space, but more on maybe on investors. Any different types of investors that are coming to the platform now? We talked about kind of types of investors you're seeing, allocators, what they're looking at, but anything new or nuance that you're seeing?
One of the big component parts of our business that will, really evolve in 2025 is the launch of a dedicated platform for like registered and tender funds, right? And so, kind of thematically, what we see, and, again, don't want to be intellectually dishonest about this, is that core allocations to things like buyout, secondaries, credit, those are going to be very, very well served in much easier to execute upon perpetual vehicles, 1099 registered, held direct at the custodian, funded up front, right? Yeah. So we want to, skate to that puck, certainly, because we do see a lot of demand, and we see demand of that even from, large clients of our end advisors, right? Who say, the liquidity profile of that and my comfort and the ease of execution there is just better for me. As much as I'd love to do the next, kind of satellite type of opportunity that may demand a drawdown. So what that's kind of developing then, Skylar, is a little bit of the things that we are working on in support of those advisors and kind of where we're seeing opportunity on that more challenged kind of drawdown institutional kind of QP suitable platform side are inherently more nuanced. It's, again, it's reinsurance, it's a seed deal. It's a highly structured, negotiated kind of economic opportunity with a strategic partner of the organization on the GP side, right? Those are the types of things that, kind of warrant the complexity premium that market will continue to offer, where some of these other kind of core allocations have become, much more executable in that kind of 1099 registered tender fund opportunity. So we're excited to kind of, be much more forward in that business in 2025. But, within that context, it means the QP side of our business, kind of that platform side, will continue to get, I think, even more nuanced, even more unique in what we bring. Be that sports, be that, alternative types of credit, be that, again, these kind of co-investment or other structured deal type of opportunities. I think that's all in play.
Yeah. Have you guys continued to see more evergreen solutions?
We do, and have always had a number on the platform, again, in that spirit of solving, even for institutional GP type of offerings and on the evergreen side, where, for, less than you would pay an active management kind of mutual fund, right? Like you can have access to, private credit, private real estate, whatever the case may be, right? Through the platform, because you're just accessing it at such an institutional caliber and price product. So we, will continue to evaluate those, continue to launch those on the platform, where suitable to kind of serve those clients. But I think a lot of the Evergreen growth, should and appropriately will be kind of on that registered product side. And yes, I mean, that's the TAM there, and kind of the expectation that slowly grows even into kind of retirement plan opportunities and otherwise for these end clients is tremendous. That will certainly continue to be the focus for us.
Yeah, definitely an opportunity. Obviously, you can call them the retail alt space, if you will, and where things are going. It's always been hard at scale to get investors in those products, right?
That's right. And so again, whether it's by virtue of managed portfolios of those registered opportunities, right, that we'll be able to kind of hand to an advisor on a more turnkey basis, or the evolution of these things into, I think what you're referring to, right, like these life cycle types of funds and otherwise, where it lives as an allocation, into DB or into DC type of opportunities. I think that's feels like it may not be in the next 5 years, but over the next 10, 15, I mean, like that's the trend is there.
Yeah.
Talk to us about the educational aspect. How do conversations usually go with advisors as you guys are talking to them about, these different funds, different opportunities? Talk to us about how you guys really need to work with them on the educational front.
Yeah, I think we're very fortunate in that we've been in this business for a long time, have a lot of our relationships, the clients that we have, we've been with for a very long time, and they are, maybe all else equal, skew a little bit more sophisticated and experienced. So there is some converting the unconverted here, I think as we like to refer to it. But really not that much. And a big credit to, the GPs, who have invested, quite heavily into the education space, and we work with a number of these firms. I think Apollo and Blue Owl, right, come to mind. Most focusedly Apollo with their academy. Blue Owl has the Nest, right, where we have leverageability of those types of resources to communicate around certainly those strategies if we're recommending actively, from those groups, but just more generally, right, the role of alternatives. We, write our own white papers, articles, ourselves, right? Certainly when we're doing something on a more nuanced basis, right? Take like a reinsurance opportunity, writing a white paper on the role of reinsurance and where it should live in a portfolio and how there are nuances even within it. And for this opportunity, how an advisor might think about sizing it within a client portfolio, right? Like that's all, the onus is on us to do that. And we're certainly, again, kind of back to the reason to have our own, fully independent research team to do this stuff, is helpful as well. So, it's a combination of kind of having all of those resources and knowing when to bring them to bear. And then frankly, just having people in chair on the, business development and research side of our business, who have had, a lot of experience talking to advisors to know, hey, what they need, and if we need to support them with incremental resources, what those are, and how to get them into their hands in kind of a very consumable fashion. A lot of the people at GLASfunds have frankly worked at financial advisors, right? They're people like myself. They started in the financial advisor business. They've worked at private banks. They've worked at RIAs. So I think everyone here has done a little bit of, I've been in the chair of the advisor and can kind of reciprocate with what they need as far as, alts education, if any. But again, maybe somewhat blessed. There's sometimes feels like there's a limited, sometimes a more limited need even for us with our advisors.
Obviously you guys have worked with a lot of managers. You guys continue to work with a lot of managers. What type of advice do you have for, somebody that's looking to launch a new fund, and get allocations from folks like, those that you guys are working with?
Yeah. I think there's a fair, there's fair coverage of the fact that there is a little bit of a winner's ball mentality that goes on in private markets fundraising, right? The big, get bigger. And that I think works well for certain strategies. And I think, again, you have to be kind of macro aware on if you're looking to launch a fund, who you are, who you're going to be competing with, and, kind of the real value you're bringing. I think, there are firms who, promote themselves as kind of capital providers, first and foremost, and, understanding kind of the universe of, provisioning capital kind of as a baseline is something that really, anybody can do at the right sizes. And so you better be of the size to communicate and really bring that advantage. I think for anybody looking to launch a net new fund today, it's very challenging. So beyond needing to really clearly execute and demonstrate what we refer to as kind of this unfair right to win, a competitive advantage that's durable and demonstrable across a track record that we would underwrite back to an individual principal level. Finding almost that first customer, that first client, that first allocator, having kind of your own, network bought in to get a toehold, kind of built so that when you show up on, Hamilton Lane, GLASfunds, any of, you think of, showing up at a consultant or otherwise, right? You're just in a better position out the gate to really tell your story and kind of demonstrate, because I think everyone acknowledges that, the operational capabilities, everyone feels like they have their own, unique deal sourcing or otherwise, right? But if it's not demonstrable and, you're not coming kind of to the table with, I think at a certain level of fund, kind of out the gate at some level, you're really going to have a hard time, kind of in this environment because the incumbents are increasingly strong, increasingly capable, demonstrating a lot of willingness to become multi-asset, right? Very, very, very challenging, absent a unique story and frankly, a pretty committed base of early LPs.
Yeah, that's good advice. That's definitely something every fund should be thinking about there.
Yeah,
definitely.
Anything you want to talk about, James, that we haven't covered yet?
I think we've covered, a lot as it relates to kind of, who we are, certainly like what we do, the advisor universe kind of as we see it. I think one of the other kind of trends more generally in the advisor universe, and this kind of impacts, kind of the alternatives business, is the growth of these large, call it mega RIAs or roll-up RIAs. This has important, I think, dynamics, especially for, junior partners and others at these firms who may ultimately be kind of the individuals who may be those allocators to kind of the more specialized or kind of early stage managers. Very, very hard, again, to kind of penetrate into those larger groups as an earlier fund. But I think as there's more consolidation in the space, there will be opportunities for really high profile teams that leave to be great LP partners for some of these smaller funds as well. And I think about where, we've gotten some of our, more interesting, compelling ideas where we see, frankly, some of the most active allocators in the space are these firms who have lifted out of, a continuous Merrill roll-up or otherwise. And, they're sophisticated. They've had infrastructure historically that allocate in alternatives. But the way they want to go about it is not, allocating to the 800-pound GPs, and they may not have, $50 million that they want to drive to every idea, right? So they kind of self-select into a more unique pool of opportunities, and there's really great alignment with those groups given what we can kind of bring on the operational side as well. So that's kind of another of those just dynamics that we see in the advisor world writ large that I think is interesting and will continue to kind of perpetuate, right? These firms will get bigger, some groups will lift out, they'll recombine, and kind of on and so forth.
Yeah, it's a good thought for sure.
Yeah.
James, this has been a lot of fun. Really appreciate you taking the time, diving into this with us and sharing your experience. So thank you for joining us. Where could people go to connect with you and learn more about GLASfunds?
Yeah, absolutely. So the website is primaryglassfunds.com. Feel free to follow us on LinkedIn or other social media. myself and the rest of the relationship management, business development team are always happy to field inbounds and emails. We get around the universe a fair bit. We'll be down at Future Proof this coming week. So again, we're really the best kind of primary points of contact, but the website is going to be one.
That's awesome. Well, I appreciate the time, James. This has been a fun conversation, and we'll make sure to include all that in the show notes. That's awesome.